My name is David Hernandez. I'm a senior research analyst here at Marquette Associates. And today I'm going to be addressing the question, does it make sense to have parity between your international equity and your U.S. equity allocations? In other words, does it make sense to have an even split between the two? The agenda for this flash talk, we're going to start by taking a look at some initial potential starting points for determining an equity allocation. We're going to do a little nerding out and look at some risk-return analysis, both in terms of historical data as well as looking out into the future. We'll see how institutional investors are currently allocated U.S. to non-U.S. equities. And then we'll wrap up this flash talk with the discussion on the performance cycle, U.S. versus non-U.S. equities. Now, before we get into the meat of the agenda, I thought it'd be helpful to give a high-level overview of some common international equity benchmarks. These are benchmarks that you'll see in the Marquette reports and your manager reports. Now, there's literally dozens and dozens of international equity benchmarks, but again, these are the most common. So let's look at the two on the left-hand side. MSCI World ex-US and MSCI EAFE. Both of these are developed country benchmarks, and the primary difference between the two is that the World ex-US includes Canada, and Canada makes up 9% of that benchmark. Moving to the right, MSCI EM Index. This is composed of 24 emerging countries. Now, an interesting point on this index is I think when we think about emerging markets, oftentimes we think about commodities. We think about energy, we think about materials as being the heavy sectors in that index. Actually, the top index in the EM, the top sector in that index in EM is information technology, and that makes up 27% of the overall index. That really speaks to some of the changing investment opportunities that you can see in that asset class. Moving to the right, MSCI ACWI ex-US. This stands for All Country World Index. This is simply a composite of the World ex-US for developed markets and the EM Index. And emerging markets make up about 24% of this index as of 2Q17. Now, all of these benchmarks, they employ what's called a market cap weighted approach. That simply means larger companies hold a larger percentage of the benchmark. Okay, and this market cap weighted approach is a fairly common approach for academics and many other investors to consider when starting their initial equity allocations. And I thought it would be interesting to contrast this with a different approach. So here we're going to look at a GDP-weighted approach. So this is taking a look at a country's GDP, how it compares to the rest of the world, and uses that ratio to assign the allocations. On the right-hand side, market cap-weighted approach. U.S. equities make up 53% of a market cap-weighted approach, only 27% of a GDP-weighted approach. Pretty noticeable difference there. Left-hand side, emerging markets. They make up 40% of a GDP-weighted approach, and only 10% of a market cap weighted approach. So you can see there's some noticeable differences there. Now, a market cap weighted approach, as I said, has larger companies make up a larger percentage of that benchmark. That means that it's usually easier to implement, lower trading costs, so it's a little more common to see. So let's do a little bit of another dive here on the market cap weighted benchmark, and let's take a look at some other things. And US equities, again, make up 53% of this benchmark, but you see small caps down at the bottom, right? Small cap stocks are in that universe, and that's both domestically as well as international. And then we have EM, which makes up about 10% there. Now, one of the interesting things about a market cap weighted approach is that the exposures within that index can and will change over time. So here we're looking at US equities as a part of the world index. This is the developed market index, and we're going back to the 70s. We can see that in the late 80s, US equities were pretty low. They were 30% of the total world index. Now, if I think about what was happening in the late 80s, I was playing Super Mario Brothers on my Nintendo, and Japan equities were at all-time highs. Japan as a country made up somewhere between 40 and 45% of this index. We fast forward 30 years, US equities are now at 60% of this benchmark. Now, this shouldn't be too surprising if we think about the strong equity returns we've seen from US equities. So as the equity returns are positive, the market cap gets bigger, it becomes a larger part of that benchmark. And in some slides later on, we're going to revisit this topic and talk about the performance cycle of US versus non-US equities. Now, one of the challenges with using a market cap weighted approach to determine your equity allocations is it doesn't take into account any risk return expectations or analysis. So let's do this analysis. We're going to use some of the benchmarks that we've already discussed. We're going to go back as far as we can. We're going to go back to 1970. We're going to put together a global equity portfolio, and we're going to start with 100% in US equities and 0% in international equities. And then we're going to move in 10% increments until we get to a 50-50 even split. Those labels down at the bottom of this chart that you see, 70/30, that indicates 70% in U.S. equities and 30% in international equities. So adding international equities historically has increased the annualized return of a global equity portfolio. And that has peaked out at somewhere between an 80-20 and 60-40 portfolio mix. Now, we're all prudent investors here, so we know that we can't just focus on returns, but we also have to think about risk, right? So let's look at standard deviation. Adding international equities has decreased the standard deviation or the risk annualized of a global equity portfolio. And that has bottomed out at somewhere between a 70-30 and 60-40 split. Now let's take these two data points and let's throw them on one chart. So let's take the annualized returns and we'll throw it up on the vertical axis. Let's take standard deviation, we'll throw it up on the horizontal axis. And we can see that a 60-40 to 70-30 portfolio historically has created the most efficient portfolio from a risk-return profile. Now, I'm looking out into the audience, and I can tell exactly what everyone is thinking. Some of you are thinking, when's lunch? And the rest of you are thinking, David, isn't there a problem with using historical analysis to determine equity allocation set today? And you're absolutely right, there is a problem, right? And the problem is that where we are today, in today's current market environment, can be very different than where we were 10 years ago, where we were 20 years ago, where we were 30 years ago. And that's one of the situations that we're seeing with correlations. Correlations between international equities and U.S. equities have risen over the last 20 years. Now, correlations, this is simply a mathematical calculation that tells you how two asset classes either move the same or move differently. And we want to see a lower number here, and that's an indicator of portfolio diversification. So what do we do about this problem? If you've been a client at Marquette for some time, you know that one of the approaches that we like to consider is diversifying our international equity exposure. Think about adding emerging markets as a dedicated asset class. Think about adding international small cap as a dedicated asset class. These two asset classes have a lower correlation to U.S. equities and can get back some of that diversification benefit that we've lost over the last couple of years. Now, with these two things in mind, with this issue of higher correlations and this diversified approach to compiling an international equity portfolio, let's look at future projections. So here we're going to look at a total portfolio. We're going to look at a traditional mix, 60% in equities, 40% in fixed income. 60% in equities, we're going to go through the same process we did with the historical analysis. We're going to start with 100% in U.S. equities, 0 in international, move in 10% increments until we get to a 50-50 split. The labels up there at the top in the red or orange, 70/30, that means 70% U.S. equities, 30% international equities. Now, there's 3 points that I'm going to make on these future projections, okay? First, adding international equities increases the expected annualized return of a total portfolio. Now, this is the same story we saw with the historical analysis. Same thing that happened. Second point, adding international equities increases the expected volatility or expected risk of the total portfolio. Now, this is something different. We didn't see this with the historical analysis. And this really speaks to this issue of rising correlations. There's less diversification benefit that you see from international equities. But for every unit of volatility, there's a higher units of return that are gained from adding international equities. If you look at the bottom row there, the ratio of return to volatility is higher for the portfolios with international equities. And that peaks out at a 70-30 mix, 70% US equities, 30% international equities. Now, this mix, we saw this in our historical analysis. We see this in our future projections. We think this is a good starting point to consider in terms of making your equity allocations. And for those clients that are interested in gaining additional units of expected return, it absolutely can make sense to move closer towards a 50-50 split. Now, with that analysis behind us and with that recommendation there, let's look at how institutional clients are currently invested. And here we're looking at Investor Force data, which compiles data from hundreds of institutional clients. We have 4 different client types. On the left-hand side, on the low end, we have 26% in international equities. And then on the right-hand side, on the high end, we have 38% in international equities. So this is fairly close to our recommended and what we saw in the analysis. No major outlier there. Now, I promised you, I think it was maybe 4 to 6 slides ago, that we'd revisit this topic on performance cycle between U.S. and non-U.S. equities. So let's do this now. Over the last 2 to 3 years, I've had the opportunity to meet with many of you at your meetings. I've sat down at the table with you, and I've opened up that Marquette book, that orange Marquette book. And I know that when we turn to the page, the performance page, and we look at a 3-year number, we look at a 5-year number, we look at a 10-year number, U.S. equities have outperformed across the board, and it's very obvious, right? So I've been at a client meeting, and I've had a client look at me and tell me, David, why the heck do we have international equities in this portfolio? And that's a fair question. It's a fair question, and I hope that this next chart can provide some perspective on that question. So here we're looking at the difference in performance between U.S. equities and non-U.S. equities over a rolling 3-year period. When the red blob is above 0, that means U.S. equities are outperforming. When it's below 0, international equities are outperforming. So yes, over the last 10 years, U.S. equities have outperformed. But if we look at the period before that, international equities outperform. And if we look at the whole history, these two asset classes have taken turns outperforming throughout time. Now let's take a look at these specific periods and look at the annualized returns over these periods. You see some pretty dramatic differences in terms of numbers. Now let's look at one of the more recent periods, November 2007, December 2016. U.S. equities have outperformed 7% annualized. That's a pretty big number. Where are we today? It's a shorter time period, year-to-date through August, but the MSCI EAFE is up about 5% over the S&P 500. This doesn't take into account what's happening in emerging markets. Emerging markets are somewhere in the high 20% year-to-date, so that's not taken into account there. But this brings about the question, is this the start of a longer-term trend? Now, unfortunately, I cannot give you a definitive answer to that question. But what I can say is we think there's some compelling reasons why international equities can continue to perform into the future. So let's talk about those reasons. First, international equities, they are not cheap. Okay, they're not cheap, but they are less expensive than U.S. equities. Here we're looking at 5 different valuation metrics. We're looking at the current and where it stacks up in its historical average, the S&P 500 and the MSCI EAFE. At the bottom, we have a composite average there. Okay, the punchline is that international equities trade closer, they're above, but they trade closer to their long-term averages compared to U.S. equities, which typically are somewhere in the 25th percentile most expensive. So there's a relative valuation story with international equities. But that's not the only thing that's happened. If we think about what happened post-global financial crisis, I think we've been hit on this. The U.S. was a little more aggressive, quantitative easing, recapitalization in terms of banks, balance sheets, and we had better economic growth relative to the rest of the developed world. What's happening is the rest of the world is starting to catch up. And here we have a purchasing managers index, which is an indicator. Those lines, when you see it over the black line or a 50 reading, that means the economy is expanding. If you see it below 50, economy's contracting. We have 4 major regions outside of the U.S. listed here, but the story is since about the middle of 2016, we've seen a synchronization of upward trending in terms of economic growth in the U.S. as well as outside the U.S. And when you marry this with the next data point, which is earnings growth, it becomes a compelling story. Earnings growth across the world is expected to be very strong this year and into next year. And as an example, emerging markets are expected to generate earnings growth somewhere around 22% this year. So relative valuations, good economic momentum, good earnings growth, these are some reasons why we think international equities can continue to perform well into the near future. So let's go ahead and wrap things up with the key takeaways. 1, adding international equities has improved the risk-return profile historically of portfolios over long periods of time. We think that a 70-30 split, 70% U.S. equities, 30% international equities, is a good starting point for determining equity allocations. For investors that are seeking out higher levels of return, it absolutely makes sense to move closer to a 50-50 split. In terms of dealing with this issue of rising correlations, we think that a diversified international portfolio can help deal with that. And if we look out into performance into the future, we think there's some compelling reasons why international equities can continue their strong returns.